Everyone says that if you live in a high-priced market like California, New York, or any of the big cities, you can't make real estate investing work. The conventional wisdom says there's just not enough cash flow, so you need to go to a cheaper market or just wait for the market to come back down. The problem with this conventional wisdom is that it's just not quite true. In this video, I'm going to share a real-world example of how you could double your money buying a rental property in the Bay Area of California, somewhere a lot of investors say you can't invest. If we haven't met yet, my name is Carson. You can also call me Coach, and this is a channel all about helping you get out of the financial grind so you can do more of what matters. I decided to make this video because this topic is such a challenge for many of you who want to invest in high-priced markets. I also have a student named Travis who lives in the Bay Area, but also invests in his own backyard and across the country in a lower price market in the southeastern United States. As I dug into the numbers on Travis's Bay Area rental properties, I noticed that he was building a lot of wealth very quickly. The main reason this is true is that the appreciation rate in his market and also across the country right now has been incredibly high over the last couple of years in 2020 and 2021. For example, he bought a property for just under $400,000 in late 2019, and now 2 years later, the property is worth almost $500,000. That's an over 12% appreciation rate in a market that's historically seen about 5 to 7% growth year by year. But even with growth rates more in line with historical averages, owning an investment property in a high cost of living area can still make sense. Now, I'm not saying that every single property will be a good deal. You still got to hunt and find properties that make sense. But let me show you an example with real numbers so you can get a sense for how this could work. The example I'm going to share with you is in the same city where my student bought his rental properties. It's in Vallejo, California, which is still in the greater Bay Area region, so it benefits from the long-term trends and the positive growth that's happening there, but it has its own center of gravity. It's a suburb with a median price in the $550 range here in 2022, and it has what John Burns, who's a consultant I like to study in real estate investing, calls a suburban feel. So these are suburban areas that are more affordable, yet they still have kind of an urban feel. They have a town core with a little bit going on. It doesn't have to be like downtown San Francisco or downtown New York, but that's the reason he chose it, was it had that mix of affordability, still close by, something he could study. So I chose a random listing off of Redfin, and maybe not quite so random, but I wanted something right in the median price range. It's listed for $530,000, as you can see, but I chose it because from a rental property standpoint, it has 3-bedroom, 2-bath. It's about 1,200 square feet, which is kind of the perfect size for me when I'm buying a rental property. Also has a garage so people can store it. It had some value add potential. The basement could be finished off to add maybe like an in-law suite that you could either rent for Airbnb or have a family member live in there. It's on a bus route, it's on a sidewalk, it's pretty convenient. So kind of all the characteristics you're looking for, in at least in that town, for something that could be desirable to have a tenant move into. Now let's take a look at the actual numbers. I'm going to assume you had to pay a premium to actually buy this property. It's a competitive market, right? And you might have to hunt around to find one that you actually win the bidding on. But let's say you pay $540,000 for this property listed at $530,000. And I'm also going to assume you pay about $10,000 in closing costs. Maybe that's a little high. Maybe you had to pay a few repairs or something like that. But your total cost in this property is $550,000. Now, what about the cash? I'm also going to assume that you make a large down payment of 40% of the purchase price. Now, why such a big down payment? One of the characteristics of a higher price market is the rent is a much lower percentage of the full price of the property. It's one of the challenges of making cash flow work on a rental property. So one way to solve that is to actually make a larger down payment to get your mortgage payment down lower. And so what does that look like? You have a $216,000 down payment if you make a 40% down payment. You also have a loan then of the balance of that purchase price of $324,000. Now I'm going to assume here in February 2022 that your interest rate is 4.125%. Of course, that could fluctuate depending on when you're watching this. And that gives you a payment of $1,570 per month, or $18,840 per year in mortgage cost. Now, I want to show you a metric that I think is very relevant when we're having this conversation about buying in high cost of living areas, or really any market, and when you're investing, is what is your cost of capital? So let me show you a very simple formula to figure that out. The cost of capital is just your annual mortgage payment. So as I told you earlier, that's $18,840 divided by your total purchase price, including those closing costs and any other costs you have. So $18,840 divided by $550,000 is a 3.4% cost of capital. That's just the proportion of your mortgage cost to the total amount you had to spend to buy this property. Now just hold on to that cost of capital metric. I'm going to show you why that's more important here in a second. Before we move on to some more of the numbers, I want to acknowledge something that might have already lost some of you, is that we made a 40% down payment, or $216,000. Now, what if you don't have $216,000 laying around, which is many people, right? How are you supposed to invest in real estate? Well, in many cases, that's why people go to a lower cost of living market. If you invest long distance, even if you live in California in a market that has $200,000 properties, making a larger or even just a 20% down payment of $40,000 is much more accessible than $216,000. So I get that. But if you want to invest locally, you could do a couple different strategies. One is moving into a property. One of my favorite ways to start investing is to make your home your future investment. So you can do what's called a house hack, where you live in one unit and rent out another unit, or rent out spare bedrooms in your house. Or if that's not the game for you and you want to have some privacy with your family or something, you can move into the house, and then a couple years later, when you move up to another house, you can keep that one as a rental property. But the benefit is you can get owner-occupied financing, which can sometimes have as low as 0 to 5% as a down payment, depending on the loan program. So that could get you in for a much lower down payment. Another alternative is to partner with someone else who does have the money. If you're someone who has the know-how and the energy to go out and find a deal, maybe you could find someone who has the money but not the time or know-how, and you could get together at least on the first couple of deals to make that work. At this point, I want to figure out the rental income for this property that I'm buying. And the first step to do that is to estimate what the property will rent for. Now, my favorite tool to do that, or resource, is to go to a local property manager or a friendly investor who also has rental properties in the area. Those type of local on-the-ground investors have the best knowledge because they're actually renting properties recently, and they have an intuitive feel, street by street often, what a property will rent for. But if you don't have that, or if you just want to back up your knowledge to that, you can also use some online tools. And I like one called Rentometer, which I show you here, to kind of estimate, compare other properties in the area and what they rent for, and to tell you whether my rent estimate is reasonable. And I also use Bigger Pockets as a rent estimator tool, and Zillow as a rent estimator tool. And I'll put links to all three of those in the video description below. But after doing my homework on that, I estimated that this property would rent for $2,700 per month, and also estimated that I had $1,100 in what's called operating expenses. So these are the expenses on your rental property, everything except for your mortgage payment, which I'll get to here in a little bit. But the operating expenses include taxes, they include insurance, they include your maintenance on the property when things break and you got to repair them. They include a management fee if you're going to hire a manager, and perhaps setting aside some money for vacancy because your rent's not always going to be coming in between tenants, and you want to estimate for that as well. So this is about 40% of the rent in this case, in this example. And so when you subtract 1,100 from 2,700, you get 1,600 per month, or 19,200 per year. This is what's called the net operating income, which, if you've been watching any of my videos on how to run the numbers, this is one of the most important numbers you always want to run when you're analyzing a rental property. Because we know the net operating income for this property, we can now calculate another formula that I always run when I'm analyzing a rental property, and it's called the unleveraged yield. This basically shows you as a percentage how much rental income your property will produce compared to its total cost. Now, importantly, this does not include any debt, even if you're going to use a mortgage on this property, because we really want to boil down and understand the performance of the property by itself. This is similar to a cap rate, although we're going to use it a bit differently in this case. So in our example, the unleveraged yield is just the net operating income of $19,200 per year divided by our total cost of $550,000. And that gives us a yield of 3.5%. So what does this 3.5% yield actually tell you? How can you use it practically? Well, first and foremost, you can compare this rental property that you have to alternatives where you could put your money. For example, you could put your money and invest it in the stock market. Maybe you would buy an S&P 500 index fund, which is just a collection of the 500 biggest companies in the United States. And if you did this as of February 2022, and I'm recording this, you would get a dividend yield of about 1.35%. A dividend is just the income you get paid as the owner of those stocks. So 3.5% on the property, 1.35% on your stocks. You could also invest that money in a U.S. Treasury bond, for example, so essentially loaning the money to the federal government. And over a 10-year period, as of today when I'm recording this, you would get a 1.92% return from the interest on that bond. So you can compare and contrast and say, am I receiving a premium? Am I getting more from this rental property than I am from these alternatives that I could invest in? That's one purpose. The other purpose, though, is that you can compare that 3.5% yield to the cost of the debt that you're going to use to buy this property. And here we come down to the question of cash flow that so often comes up in higher cost of living markets. Really what we had to do in this example is make a much bigger down payment in order to reduce the cost of our debt, the cost of our capital, the cash flow that's going to go out of our pocket to a point where it's at least equal or close to the amount of income, the yield that this property will produce. So in our case, if you look at the two different numbers, we had 3.5% is the yield on the income of the property, and the cost of capital was 3.4%. So it was $18,840 divided by $550,000 cost of the property. So this one number, the 3.5% unleveraged rental yield, really shows us the essence of the challenge of buying properties in higher price markets compared to buying them in lower price markets. For example, in Clemson, South Carolina, in the southeastern United States where I live and invest, it's not unusual to be able to find a very similar house that has an unleveraged rental yield of between 5 and 6%. At the same time, the cost of my financing in South Carolina is not going to be significantly different than buying in California. So that allows me to have a smaller down payment and still have a break even or a positive cash flow. But here's the big question. Back to our original question of how can you make money, even double your money in a high cost market? Does it automatically mean that buying in a high cost market is not as good of an investment as a market with more cash flow? Well, not necessarily. To understand that and really analyze this particular deal, we've got to look at some more numbers. So let's take a look again at our single family house in Vallejo. And the main questions we want to ask ourselves is how are we going to make money on this rental property? Now I'm going to give you 3 core ways you can do that. And number one is with cash flow. We've already discussed cash flow some, and in this case, there's not going to be a lot of it, but you do have $19,200 in annual net operating income. And when you subtract your cost of financing or your cost of capital of $18,840, you have a $360 per year cash flow. That's our profit center or our wealth building source number one. Our wealth building source number two, though, is that we're going to pay down the principal on our loan. So even though we called that a cost of financing or a cost of capital, a portion of each one of our payments reduces what we owe on that debt. So in our case, that's $5,583 that we will reduce our debt in year one of paying down that mortgage. So that's profit center or wealth building center number two. But source number three is actually the most important one, especially in high cost markets, and in Vallejo in this case, is the price appreciation of the property. Now we were comparing low price markets and high price markets earlier. Well, in high price markets, a big source of the wealth building that's happened in the past with single family houses and other real estate in those markets has been the price appreciation. And the reason they are actually high price markets is because they've been appreciating faster than the other markets have been. And so what number do you use? Well, you got to do a little bit of digging, and you also have to do some speculation. This is not an exact science. But what you can do, and I'm going to use a tool called Neighborhoodscout, which I don't have an affiliation with, just think it's an interesting tool to analyze what's happened in the past in California as a whole, but also a little bit in Vallejo as well. And if you look back and see that all the way back to 2000, since 2000, the real estate market in California has appreciated on average at about 5% per year. Now, it's been on a tear recently in the last couple of years. You're seeing numbers like 15 and 20 and 20% plus appreciation rates. That means your property is going up by 20% in 1 year. That's just a really unusual number. It's been in the news a lot because of that. But if you're looking forward and you're trying to make your best estimate, you want to be much more conservative than that. Can that really keep it up? Can that really continue on? Probably not. So, if we're just trying to figure out how can you make money in a more conservative way, even in this high price market, we might look back at the average. And let's say if California averaged 5% and Vallejo was actually a little bit below that at 4%. But in our case, if we said, what if it did hit 5%, that would be a $27,000 per year price appreciation of this investment property. So we are, compared to the cash flow, compared to the principal at pay down, this is a significant source of wealth building. And when you compound that over time, you're going to make a significant return on your investment. Now, how much of a return on your investment are you actually going to get? Well, you need to compare that to what you actually put into the property. In our case, we invested $226,000 in cash. Remember, we made a big down payment and we paid some closing costs. So if you compare that to our sources of profit here, we had $360 per year in cash flow. We had $5,583 in principal pay down, and we had $27,000 in appreciation. We made just under $33,000 in wealth. We've built that much wealth in 1 year. And yes, that's on paper. So you can't eat that appreciation until you sell the property or refinance it. But if we're counting how much our net worth is changing on a year by year basis, that's about $33,000. And to the main question that we started this whole video with, could you double your money in a high cost market? Well, with that kind of growth, with a 5% growth rate, $27,000 in year one, that'll go up every year. So will the cash flow, so will the principal pay down. We could probably double our money in about 7 years. That means we've built wealth of about $226,000 by year 7, plus we have our original $226,000 that we invested in the property. So just an interesting way to analyze it, to see that there are different ways to make money in different markets. They have their pluses and their minuses, but in this case, you can double your money in about 7 years. So I want to give you a takeaway, a practical way to remember the lessons from this case study in this video about making money with high-priced markets and real estate investing. And I want to do that in the form of a checklist to help you remember some of the key points. Number one, you want to find locations with higher than average growth potential. Now remember, there's an art and a science to this. And I actually have an article that I'm going to put in my video description below where I give you all of my different ways for analyzing a market to figure out, is the population growing? Is this a market where the economics are looking good on the big picture? But also then finding neighborhoods where you're going to have the most likely chance of having high appreciation within your town. So check that out. But number one, you got to find the best locations with the highest growth potential. Number two, you want to buy simple, low maintenance, high demand rental houses. You don't want the biggest property in town, a 5,000 square foot house. You want a simple one that's easy to maintain for you as the landlord, but you also want it big enough and desirable enough that your tenant's going to move in and want to stay there as long as possible. That's why I mentioned kind of the bread and butter, 3-bedroom, 2-bath, 2-car garage is a great kind of suburban style rental property. That doesn't mean you couldn't buy a 2-bedroom house or a duplex or an apartment. There are lots of different desirable apartments, but find the one in your location that is both in demand is also an efficient rental for you. Number three, you want to buy a property at a price where your unleveraged yield, remember we spent a lot of time on that, is greater than or equal to your cost of capital. That's how you can make sure you get cash flow. In a higher price market, that might mean you have to pay a larger down payment in order to get that equilibrium, to get that balance. And in other markets where the cash flow is a little bit higher, you'll be able to do that with a lower down payment. But that's an important metric to make sure you're having a positive cash flow. Number four, if you're buying in a higher cost market, you're probably going to need to save up a larger down payment. So spend the time, be patient, save your cash, or maybe partner with someone else. You have someone else who has half the cash and you have half the cash. Maybe you could form a partnership. Or if you're a really aggressive entrepreneur who doesn't have as much capital, but you can partner with someone who has all the capital, but very little time. That could be a good trade-off where you work together, you provide the deal and the work, they provide the money, and you can both make money together. And then finally, you can also get creative with your down payments. I talk a lot on this channel about creative financing, lease options, and other seller financing, other options. If you get good at negotiating that type of deal, sometimes you can also get properties with lower down payments as well. Number five, you just want to hold the property and be patient. This business is called buy and hold rental for a reason. You got to be patient. This isn't going to happen overnight. Yes, we're in a very aggressive hot market right now, and markets could soften up. The prices could even go down a little bit. But if you're buying in the right location with the right metrics, you're fixing your interest over a long period of time, that is a long-term recipe for building a lot of wealth. You got to be patient with it. You got to stick with it. Set yourself a goal. Maybe you want to double the amount of equity you invested into the property. Maybe you want the price of the property to double in value. Set some goal for yourself. And then when you reach that goal, reevaluate whether you want to sell the property and reinvest those profits somewhere else, or whether you just want to keep that property and keep moving forward. So we've gone over a lot of details and numbers and the case study in this video. So if you like this form of explanation, if it helps you understand real estate investing better, I think you'll like my next video where I show you the big picture of how just 4 rental properties could set you up for life. So I go into the details of the numbers of each of those rental properties to help you get a big picture goal, to show you how you don't have to have a huge empire of thousands of units in order to be very successful as a real estate investor and to pay for your lifestyle. So if that's something you're interested in and you want to understand it and get your head around it, check that video out. I'll have a link below in the video description and also a link above me as well. You've been watching the Coach Carson YouTube channel. My name is Chad Carson. You can also call me Coach. And this is a channel all about helping you get out of the financial grind so you can do more of what matters. See you next time.